For those of you that have just joined the meeting, thank you for attending our webinar. We are very excited to have Brian Truett join us. Brian is the founder of Truett Insurance Agency. I really think of Brian as the insurance agent for insurance agents, extremely knowledgeable and just really loves sharing all the information that he's coming across and diving into in terms of the insurance landscape. And he's really going to be touching on homeowners insurance in California. For those of you that don't know who I am, my name is Alex Black. I'm an advisor with Integris. And before we have Brian kick things off, I'm going to turn things over to Cynthia Guerrero, who's a paraplanner in our office, and she's going to just go over some things that are good to know about how to use Zoom inside of the webinar, as well as a few disclaimers. Cynthia?
All right. Thank you, Alex. First off, thank you everyone for joining us here today. If this is your first time attending a Zoom webinar, we want you to know that we highly encourage audience engagement. If you look at the bottom of your toolbar, you'll see a Q&A symbol. This is where you can submit questions to Brian and Alex. Also, for the best viewing experience, you'll want to roll your mouse over to the upper right-hand corner of your screen and select view and then speaker view, just so you'll be in a full screen mode. Brian shares a lot of helpful tables and a lot of information on his slides, so it'd be best if you have it in full screen so you can get the best user experience. Also, if there are any questions that we don't get to during the webinar, we'll make sure to follow up with you individually after the presentation. And additionally, a quick disclaimer, this presentation is intended for educational purposes only and should not be considered investment advice. And with that, Brian, would you mind kicking us off?
Happy to. Let's see here. All right. Can you see the screen?
We can.
Yes.
2026 California Sure. All right, great. Yay. It de-stresses me once everyone can see the screen. I was telling Alex before we got started that I have these panic moments like, what if Zoom doesn't work? So anyway, the presentation, this is a presentation that I gave for the 2026 Financial Planner Association conference at the San Francisco. I've shortened this considerably because there's a lot of data that I had in it that's more geared towards financial advisors. So I'm used to giving it in one way, and I'm going to give it a different way today. So if the cadence is off or you have any questions as we go, happy to answer them. If you have questions afterwards on a personal issue, I'm happy to talk about that. You don't have to, if you email us or ask a question, that doesn't put you on a mailing list for the rest of your life or mean you have to buy any insurance or anything. So we really believe in sharing information and having that information be available to everyone. And it's one of the reasons we all know each other from Integris and my company. So what we've got going on right now in California is a genuine crisis. And I want to start by saying how to fix the market. So we have a law from 1988 that's affecting how things operate today in the state, Proposition 103. That law needs to be either repealed or it needs to be amended because it's creating a lot of problems. We also have three seminal laws that were passed in 2018 as a result of some wildfires. And those combined with Proposition 103 are creating problems for carriers with pricing. And you'd think that having pricing limitations on carriers would be a good thing. But in fact, it's had the opposite effect in California because what happens is there's no competition for any carriers. So if they can get rate increase, they take it. And they're like, if you don't like it, leave. But there's nowhere to go. So what we need to do is allow carriers to price their policies for profitability. We need to increase. They have to consider when they make an increase. Like in California, carriers aren't competing, but in Arizona, we have an office there. We have a carrier that really wants to write more business there, and their auto is more expensive than their competitors. And I said, if you want to write more business, you have to lower your auto. So what they're doing is now they are filing an action with the Department of Insurance to lower their auto insurance so they can be competitive. That's what we need is competition in California. We want to allow carrier coverage forms. So carriers keep wanting to add like wildfire deductible and sliding scales of coverage. I'll get into what some of that means, but creating a market where people can offer what they want to offer would be a really good idea. And then we need to create and enforce a process for consumer disclosures. One of the biggest problems we have in the insurance business is if you call, say Alex, and you say, I want to invest some money, Alex has to go through a process by which he discloses that that money could be at risk if it's in the market. And how at risk would it be? Like, what's the difference between ultra high risk investments like crypto, and what's the difference between, blue chip stocks, for instance? If you call me up and say, I want to save money, I can legally sell you an insurance policy with less coverage for less money and not disclose that I did that to you. That's a problem with the insurance business across the entire United States. And it's one of the reasons that we're in this crisis that we're in now. So I'm going to talk a little bit about different parties that are involved, but there's 9 of them I want to discuss really quickly. And I asked ChatGPT, if California insurance market were a house, what would it look like if 9 people who knew nothing about construction built it together? And this is the picture that ChatGPT gave me. It's this really nice house with a toilet with a view here out on the, what I guess is a patio. And I counted the people and there was only 8. And I asked ChatGPT, where's the 9th one? And they're like, yeah, one went drinking. So this is fun with AI, but this is really what the California market looks like, with all these different people trying to get different things done. And here's what I mean by that. The consumer is largely driven by cost versus data. So most people don't really touch insurance unless they have to. You're either buying a house or buying a car, something's happened and it's made you shop. And so consumers don't know a lot about insurance. So they look at a price and they look at the coverage and they think, okay, they do a little calculus in their mind and they buy. So they don't know what to look for. So consumers are lacking data. The carriers, they like that sort of ambiguous environment, because all of their advertising, like Geico and Progressive and all these companies that advertise on television, they don't really talk much about coverage. They'll say they're good, but they don't give you data. Like, how is a claim going to be adjusted when you have a claim? And there's also language that's very difficult to understand, and a lot of people believe is disingenuous because it doesn't seem to say what it means, which is in a lot of ways true. When there's large claims, there's delays because insurance time works differently than real time. Insurance companies need to quantify what losses are, and people are used to asking their phone for information and getting it in a second. So there's dissatisfaction there, and the carriers have their part in it. The California legislature tries to fix everything with law. So that in many cases, the reason we're having this crisis is because of law. The people in the legislature have written laws that have affected how the business works. And now investors and people who back insurance are running away from the market. Proposition 103 made the Department of Insurance an elected position. So the person who's running this multi-billion-dollar industry in the biggest insurance market in the country doesn't know anything about insurance or business. He's just an elected official who has good intentions. And I'm sure he's a very nice guy, but Ricardo Laura has single-handedly pushed us into the tipping point where the entire insurance business in California could collapse because he doesn't know anything. Consumer groups, there's some really good ones, but there's some that are bad. Like when you read an article in a newspaper about Consumer Watchdog, for instance, Consumer Watchdog wrote Proposition 103 that gave them the ability to file suits against carriers and charge the money to consumers. That never gets mentioned in the Los Angeles Times or the Wall Street Journal or the San Francisco Chronicle. And so, they're quoted as if they're this altruistic group of people who, have no skin in the game, but they absolutely have skin in the game when they're talking about carrier actions in California. Investors are interested in profitability. So when we see big cities burning down or we see lots of losses across the United States, investors are the people who are buying insurance stocks and funding risk. And so they're not seeing profitability, they withdraw from the market and look for other markets. In our world, these insurance agents have a lot of, most of the people in my business are salespeople, and they're not in the business for very long. So there's a lot of inexperience, and they don't have that fiduciary duty that I talked about to disclose important details. And so you get agents pushing products that are potentially dangerous to a client, but the client doesn't know anything. So they go ahead and buy it. And because the consumer is driven by cost versus data, they fall victim to a lot of problems in the insurance market that could be avoided if someone were to take the time to explain to them. And
Brian, that's probably a good just jump
yeah,
in. We had a question come in
yeah,
from the audience and really asking, what can you do to protect yourself against that, or how can you identify an agent like yourself or like some of the other agents that we trust that are truly kind of working in that fiduciary capacity, even though they're not
yeah.
held to it?
Um, I'll have some data in this presentation with some hard, like it's real data that you can take away and use and ask questions like how much ordinance or law is in this policy? Am I covered for personal injury? Those things. I'm going to give you some data that
Okay.
will allow you to give questions to an insurance broker. But one of the first questions you should ask an agent when you're interviewing them is, if I have a claim, who helps me with that claim? Are you going to help me with that claim? Will you be involved, or am I on my own? Because a lot of insurance agencies don't get involved in claims at all. They hire the company that they're working with to act as a service agent for them so that they can sell more policies. So will the agent be involved is a great question. What do you
Right.
know about claims? How many of you adjusted? Yeah, you go through a lot of agents that way, I'll tell you that. Um,
That's the deal.
the media sells advertising. And so when you're reading articles in the San Francisco Chronicle, there's been several that are they're saying, oh, this company's raising their rates, company bad, you know, they're giving you data in their stories, but it's not complete. I've many times sent the timeline of this crisis to journalists at major insurance papers, and their response back to me when I analyze this crisis is, what you're saying is too nuanced and too complicated for us to print. No one will read it. And the problem is if you don't understand how complicated it is, then you can't fix it. So what people are getting from the media is not really the story that's going on, and you need to know that. And then I've added municipalities because this is a driving force in what's happening in real time right now in California. In the Palisades fire, the the city was completely unprepared for a wildfire. They had water problems, fire department problems. They had no plan. And And the statement over here is, it was really a phenomenon we've never seen. That was the Carlos Herrera, spokesperson for the fire department. But the thing is, we have seen it. This is a picture of Coffee Park in Sonoma County. That's 2017. Paradise, California. This is Lahaina, Hawaii. I have more pictures, but this will give you the idea. And the thing is there was an 8-hour delay on evacuation orders to West Altadena. So 17 people died. They were calling 911. So not only did they have no plan for fire, but they had no plan for personal safety at the Los Angeles Fire Department. And when you take a step back as an investor or an insurance company, we have to really look closely at what does it mean to have a fire hydrant next to your house? What does it mean to be near a fire department? When the fire departments don't respond and the fire hydrants don't work, about 80% of the houses that burned down in the Palisades were not in high risk areas. So now we have to reevaluate what we think is high risk in California. So when your carrier is telling you this is high risk, and you're like, no, no, I live in, Danville, California, it's never going to burn down. That's not the way we feel in the insurance business anymore. So these are real results of what's happened, to drive some of the costs, perception by investors. I want to talk a minute for insurance terms because I'm going to use a bunch of them as I start to give you some data. So insurance terms, these are invisible parts of an insurance policy. Replacement cost or actual cash value. Replacement cost is if I give you the money or the thing back. So if you have a sofa that gets smoke damaged and it needs to be replaced, if it's a 3-year-old sofa that costs $2,000, replacement cost is $2,000. Actual cash value is the $300 depreciated value that they're going to give you for that sofa. So if you don't know how your loss is going to be settled, you may be disappointed in how it gets settled. And so a lot of people don't realize that when they have an insurance policy in a standard market like State Farm or Farmers or Liberty Mutual, when you have a loss, you have to make a list of what you lost. And if you don't go buy those things, you only get actual cash value for them. Or maybe you've written your home on an actual cash value form versus a replacement cost form. So you're getting depreciated value. How your loss is settled makes a big difference. Knowing what conditions that you'll get either cash or replacement cost versus depreciated value is important. Building ordinance or law. Was there a question, Alex?
No, I was just nodding. I
Okay.
think that's very true. And until you actually have a claim, you're just like, yeah, I've got coverage. But all of a sudden,
Right.
you get
We
to a
only
place
find
where
out building ordinance or law is how a house gets rebuilt. So if you don't have enough of this, like if you live in a 1975 home and it's been remodeled, it still might have some seismic energy codes, all kinds of different things that once the house is damaged, now you have to spend money on. In California, a policy in the admitted market is supposed to have 10% minimum. But we write policies that have 100% of this. So if we have to tear down part of a house to rebuild it or something like that, you have coverage. But building ordinance or law is one that people don't really understand or even know about. And extended replacement cost, this is an inflation hedge. So most policies have some form of extended replacement cost. This is if you have $1 million house and it burns down in a conflagration, so a large fire. You're going to have a demand surge after that fire in services and building. And so what we do in the insurance business is we put this extra coverage in. So if that $1 million home is rebuilding for 25% higher, say maybe you need maybe you need 1.25 million. But in these big fires that we've seen, like in Los Angeles and in Northern California, we're seeing houses rebuilding. $1 million house is rebuilding for 1.5 to 1.9 because of all the demand surge that we're seeing. So if you don't have enough extended replacement cost in your contract, you may not be able to rebuild even if you were insured to value, which I'll talk about being insured to value on another slide. Sewer and water backup. I mentioned this because even though we're talking about this insurance crisis and the terms that the media and the Department of Insurance like to talk about are climate change and things like that. Sewer and water backup is my number one cause of loss by sheer dollars spent in my insurance agency since its inception. We have these claims in the hundreds of thousands of dollars. And because of that, carriers have a tendency of putting limits on sewer and water backup. Either there's no coverage at all, it's excluded, or they give you $5,000 or something like that. So knowing about sewer and water backup is very important. Another one is personal injury. Personal injury is a part of the liability contract on a homeowner's policy. So a homeowner's policy, if someone falls down and gets hurt on your property, that's bodily injury. If you were, say, golfing and you put a golf ball through someone's plate glass window or their car, and I've done this, unfortunately, you put a golf ball through a Mercedes, that's called property damage. But if you have a child with a mobile phone and all the kids are texting each other a bunch of stupid things like kids do, and a parent believes that their child is being cyberbullied and they file suit against you, that's called personal injury. Personal injury is libel, slander, false arrest, mental anguish. So if someone sues you for how they feel about something, like a restaurant review or something like that, that's all personal injury. 85% of all the policies that we review do not have personal injury coverage on them. California and all the other states, starting in about 2003, when social media really got its legs, people were suddenly able to publish their opinions very easily, and they started saying mean things to each other on Facebook and other platforms, and then they would sue each other. And so the carriers didn't like the loss ratios associated with that, so they just quietly took that coverage out of their policies, and you have to add it back in by endorsement. So this is one of those things that you can go look at your policy, and if it doesn't say it on the declarations pages that there's personal injury, it's a $15 coverage. It should be on every insurance policy, but this is one where we see that's not there almost, well, 85% of the time, which is a lot.
These are great examples, Brian, and I think just based on an earlier conversation we've had, these are just ways insurance carriers, to your point, are taking out coverage to make policies more affordable, and people
Yeah,
are likely not aware of it.
absolutely.
Certainly something that I know you do for your clients is review for these types of coverages, and at least at minimum make your clients aware of the risk. That's obviously something that we do through our process as well,
Yeah.
when we're working with the individuals that we work with.
Yeah, it's amazing what a little bit of analysis will get you, right? Like,
So true.
just real quick, admitted versus non-admitted. There's a lot of confusion about this. Admitted carriers they're licensed by the state of California or whatever state they're in. There's a state guarantee association. The carrier has to file its rates and its policies with the Department of Insurance. They're limited by Proposition 103 on how much they can raise rates. 6.9%. If it's over 6.9%, they can be audited by a consumer watchdog. And then Consumer Watchdog charges all this fees and then charges it to the consumer through the insurance company. But there are some consumer protections. Like, so if the Department of Insurance gets involved, they might tell a carrier like State Farm, you have to pay this claim, and State Farm has to pay the claim. Non-admitted carriers, none of that exists. They're not state licensed. There's no guarantee association, and there's no guarantees. The financial rating of the carrier is what it is, and if they run out of money, they run out of money. Their rates are not filed, and they can charge whatever they want. And they have to follow the law in California, but they are not regulated by the Department of Insurance. So if you need to enforce your will with one of those carriers, you have to file a lawsuit. And so this is the direction that most carriers are going now, non-admitted, because the California Department of Insurance has limited everything with Proposition 103 and these other laws that I talked about. And so carriers are moving in this direction, which I have some slides to kind of talk about what that looks like. Let's see. So this is a slide that I've used for many years. This is what the insurance business really looks like for consumers. At the one end of the scale, you've got a single dollar sign. These are policies that are very no frills. You might buy an older building as a landlord, or you inherited something. You're trying to save money on insurance, but you don't have coverage like sewer backup, or the policy might be actual cash value. Maybe at the building you're going to renovate, so you don't really care if it burns down. At the other end of the spectrum, with the $3 signs, you've got policies that are really easy to get money from the carrier. Think Chubb. Your house burns down, a smiling person shows up at your house and writes you a check for the full amount with no questions asked, and they have extra 100% extended replacement cost, and everything is replacement cost with no lists or anything like that. And in the middle, this is what we call the middle market. You have carriers that have designed their insurance policies based on statistical claim data. So they know that if you have a sewer backup, for instance, maybe you're going to have a $5,000 sewer backup. They still want you as a client and everything is fine. But if you have a $400,000 sewer backup, they're going to say, oh, well, we're sorry you have this 5K limit. Or maybe they only give you 20 to 50% extended replacement cost, which in a normal market would be fine. You're statistically covered. If you have a standard deviation loss, inside of this bell curve, then you're fine, right? If you have a catastrophic loss and you have to rebuild, this is where the sublimits begin to protect the carriers. Sublimits are things like building ordinance or law, sewer backup, actual cash value versus replacement cost. All of these policy terms begin to take on a new meaning if you have a loss that falls outside of the standard statistical model. And the standard statistical model is where 90% of the people on this call are going to be, because think State Farm, think Liberty Mutual, think Farmers. These are everyone who advertises on television. That's the middle market. And so the problem with this, it's not good or bad. It's that no one knows this exists. So you don't find out you only have 10% building ordinance or law until you need 50% building ordinance or law, because in San Francisco, if a house is 50% damaged, you have to tear it down and rebuild it. So that's building ordinance or law, to tear something down and rebuild it if the insurance company doesn't want to do it. So
Brian, I really like this slide. I mean, it really explains just kind of what an average consumer, kind of what their coverage is actually covering, which is really that middle section of the bell curve,
yeah,
and where they're exposed. And I mean, our take, and I know yours is too, the real point of insurance, and the real at least idea of insurance in our minds, is to protect against catastrophic loss. What you really see on the far right hand side, or kind of that far right hand third of this pie chart, or excuse me, bell curve, is really that catastrophic loss, and insurance companies in the middle market removing themselves from that. So I
yeah,
think
you're
it's really
absolutely right.
important. Yeah.
You're absolutely right, Alex. Where you want to insure, you want to take higher deductibles, retain risk on the low end, and take catastrophic loss and have as much catastrophic loss as you can. This is becoming a problem in the state because of this insurance crisis, which I have a slide for that as it happens. But one thing to know is the industry is experiencing high losses across the entire market. The only time I'm going to spend on this slide is to say that in 24 and 25, the loss ratios from carriers have been improving. And everyone says, oh my God, that's great news. But what it really means is that carriers have been pulling back from the market and charging higher rate. So the reason that we're down to a 96, which is actually great loss ratio overall, because this is combined loss ratio, it means the carriers are profitable. But the problem is, that's at the consumer expense. All the investing community has backed off of this thing, and they're charging a lot more. So this slide has a lot more context to it, but none of you are financial advisors except for Alex and Cynthia. So I'm going to skip it. There's a lot of industry pressure, though, being driven by this. So the thing to understand is steady losses is where the problem is. Aging homes, we have water, electrical, roof problems. I was told 3 times this week, and I'm not exaggerating, 3 different people told me my roof is fine, it doesn't leak. But you have a 25-year-old composition shingle roof with degranulation, and people think that it's okay because it's not leaking. And the carriers know this now. And so we're having these claims, and carriers are dialing in on where their losses are. And so when we have these steady losses, of water is the number one cause of loss in the insurance business. And so in my agency, water is number 1 through 6 on losses. It's different types of water. It's sewer backup is number 1. Then you have water intrusion from storms. You have water from pipes bursting, water from this, water from that, but it's water. You don't get to smoke until like number 7. Now you'd think with all the fires that wouldn't be the case. So we have these big shock losses, but the shock losses aren't where our problem is really. Those could be fixed if fire departments had a plan and we cut some brush down and things like that. We also have increased auto loss amounts. Like, talking a lot about home, but when we're talking about overall accounts, we have this super expensive tech now. I've paid $5,000 on a claim for a Toyota Camry bumper now because of cameras and sensors and things, and that used to be a $500 deal. So we're seeing all these losses from really small accidents that are costing 20 or 30 times what they used to cost. And so we're seeing rates go up. And then we have these Prop 103 also says that carriers can't charge if you have not at fault claims. So you file a glass claim or a vandalism claim or a theft claim or something like that. Um, you can't get charged on your auto insurance for that. And so what's happening is the auto insurance has been unprofitable in California. And so they're trying to get more rate for that. And carriers are forcing people to write home and auto in the same company. So a lot of times having these claims is a big problem. Um, the shock losses, we could do something about these. There's not much you can do about planning for a hurricane, but fire is something that you can plan for, and it's not being done. Everyone is concerned about, political implications of what happens and not what the actual material results are. And so it's been a problem. One thing I want to say on the right hand side over here, you've got travelers stock dives as revenue misses. What I mean by this slide is revenue is dividend revenue. So when Travelers was having a lot of hurricane claims in 2024, they weren't paying out money in dividends because they were unprofitable. So as nice as Alex is, he's not going to keep Travelers stock in one of his portfolios if it's not performing. And if Alex starts selling off Travelers, that means that the stock price is going to go down more. And then other financial advisors might say, we're going to do the same thing. And so as people trade out of a non-performing stock, it affects that carrier's credit rating. Travelers has no choice but to raise rates and cut risk if they want to stay in the game. And so we are all connected. There's not anyone on this call that doesn't own either Travelers, Chubb, Hartford stock. Insurance companies are blue chip stocks. They're the staple of portfolios and part of them. And so, we have to always be mindful that we're all in this together. Like we're all connected. The insurance companies aren't acting in a vacuum. But there is this little thing called reinsurance. And you need to know that when a company sells you insurance, a lot of times they sell some of that risk to a reinsurance carrier. And what's happening is that reinsurance carriers are now wanting more money for risk. And like, for instance, Nationwide left the market a couple of years ago on some of their business. And the media said, well, Nationwide's a bad company because these people had Nationwide for 20 years and then Nationwide canceled them. Bad company. These people are so nice. What happened is Nationwide was paying more for the reinsurance on that policy than they could collect from the insured because they can't raise their rate because of Proposition 103. And so that didn't find its way into the media coverage. It was just carrier bad, consumer good. We have this crisis. Shame on you, Nationwide, for not being willing to lose money on this account. And so this is a real problem if you don't understand why they have to leave the market, because if they have to leave the market, everyone has to leave the market, right? It's not going to change. And then inflation is self-explanatory. If you're paying more at Home Depot, we're paying more at Home Depot when you have a claim. And so, everything is being affected by transportation costs, the cost of oil, everything like that. So we'll see insurance costs go up across the board for those things too, because we have to pay for it.
I think it's helpful when you tie that stuff together, Brian. I mean, I don't think the average consumer really understands just how circular that process is between the insurer and themselves, and some of the things you mentioned earlier, some of the policy decisions that have occurred, as well as some of the municipality decisions that have occurred, as well as the others that you mentioned on the slide. So I really appreciate you tying that together.
Yeah, we're all fish on the same reef. I mean,
so true.
We can't poison one without poisoning them all. So I'm going to go light on this, but I want you to understand, I've talked about it a little bit. Proposition 103, the Department of Insurance is a political position. There's limits on rate increases. There can be interveners. That's like people like Consumer Watchdog that can, if there's a rate increase over 6.9%. So Prop 103 is really a stranglehold on the insurance business as a whole. Oh, darn it. I didn't put the names of these laws. It just says AB. Well, AB is the name of a law in California. It just has some numbers. But here's the deal. In a declaration of emergency, an insurance carrier has to pay it's it's a replacement cost, it's extended replacement cost, and it's other structures and some other things in cash replacement cost, um, so that someone could go buy another home someplace else. Um, the thing is carriers aren't priced for this law at all. So your two biggest, like on the private client side, you have Chubb. Chubb is a carrier that will write a check. If your house burns down and it's $1 million, they will write a check for the $1 million and they'll give you a check for your contents. Full pricing, no problem at all. They do it all the time. Chubb has 200% extended replacement cost. What they're not prepared to do is write you a check for 200% in cash, because 40 or 50% of people don't rebuild their houses, and that is built in to Chubb's pricing. Chubb knows that when they give someone that cash, they might be older and they don't feel like rebuilding a house. They might have grandkids down in San Diego, so they're going to buy a smaller condo. Like things, 40 to 50% of all of our large loss clients never move back into their house. So Chubb said, if we have to pay out that money, we need to raise our rates. And the Department of Insurance said, no, that's bad for the consumer. So Chubb began to back out of the market. State Farm is a carrier that will give you 150% extended replacement cost if you rebuild. If you don't, they only give you actual cash value. So State Farm is priced for that. They know that people are going to take actual cash value on a lot of losses. They're not going to rebuild. State Farm was priced for the reality of how people make emotional decisions. State Farm and Chubb were both in the same boat with their pricing with these laws. And that is what has caused our biggest problem in California right now. From 2018, where these laws were passed, combined with Proposition 103, we've seen a downward spiral. Carriers are exiting markets. The rate increases are limited in admitted carriers, but we're seeing massive rate spikes on non-admitted. A lot of you have probably experienced it. Carriers are rationing their limited policy count. So admitted carriers are saying we'll only write in these areas, or we'll only write if you have a clean 5-year loss history, or we'll only write if you do these things like put in leak detection services or alarms, or if you don't write your auto and your home and your umbrella with us, then we won't do it. And when you combine all those things, sometimes people have an auto loss that keeps them from buying a home policy because you can't combine it because they have a bodily injury accident or something. So there's all these if-then statements now that exist in the market, so the carriers don't write business. And carriers started forming non-admitted carriers. It's very expensive to spin up a carrier. So when a carrier is making a decision to do that, it's a long-term play. This is not going to go back the other way. They're looking out 20 years on their forecast on loss ratios, and they've left the California Insurance Department behind. No one's even calling them anymore to find out if they can get a rate increase. It takes 2.5 to 5 years to get a rate increase. And when you do, you're already 5 years behind the 8 ball. So why not just go to a non-admitted carrier and charge what you want? This is what's happening. We're seeing them limiting coverages in the non-admitted space. So we're seeing, stated loss of use limits and lower extended replacement cost and lower building ordinance or law. The market is responding to what the law and the pricing is allowing the carriers to do. So it's not surprising that California surplus lines carriers jumped from 31,000 carriers to 150,000 carriers. So there's 5 non-admitted carriers that we do business with who I think have the ability to pay their claims. There's 150,000 doing business in the state of California right now, and some of them I've never heard of. Every week I hear of this new carrier. What's happening is private equity and hedge fund people are spinning up these carriers. They're coming into California. They have very little insurance. They have very little backing financially. They're hoping to write business at undercut rates of the people who know what they're doing. If they can go 2 to 5 years without having a big conflagration, they make all that premium and then they non-renew everybody and they're out. That's what's going on. So people like Chubb and Travelers and State Farm that aren't writing, they've created a vacuum. And what the media is talking about, what the Department of Insurance is talking about is this: oh, the market's opening up. All these insurance carriers are coming in, but what can you buy? Can
Yeah.
they pay their claims? You know?
No, Brian, that's helpful, and that's actually a audience question came in, just kind of wanting you to touch on the non-admitted carriers versus admitted, and I know you've brought up some really helpful differentiations between the two, but what I've heard that really stood out specifically on this slide is there are a lot of new non-admitted carriers coming into the marketplace, and I
Yeah.
think a natural question comes, which you may or may not have a slide for later, just like how do you evaluate the quality of a non-admitted carrier so that you know that you're not going to have to go through a litigious process if they're not going to pay a claim and you have to experience one.
I honestly don't have an answer for that because it's sort of a Scylla and Charybdis choice, right? You've got Fair Plan's got $400 billion of liability and maybe $4 billion of paying ability, so they're insolvent.
Yep.
You've got these little carriers. Is there another carrier that has more of a history, like Chubb, Pure, Cincinnati? Nationwide has a Scottsdale product, Vault. There's a few carriers that are established, but I saw one the other day called Safe Port. Like, what's that? You know, A- and you know, they're half of what the Cincinnati policy that we replaced it is.
Yeah.
Half. So we came in with like a $14,000 quote and they were like 5,000. And my client, what I told him was, look, I'm not writing anything like this. So you can keep this and you can always call us for advice, but I'm not putting this in my agency because I don't want to be in the lawsuit when this company goes bankrupt. And even CIG, they were a really good little company. CIG went bankrupt. California Capital Group, they went bankrupt in the Paradise Fire. They're still around, but only their name is around. They're gone. They had to be taken over in conservatorship, and then someone bought the name and they got the claims paid, but they're not CIG anymore. So
That's helpful clarification. I mean, I think for people that are pursuing non-admitted carriers and they just may not have a choice, it's a little bit of the Wild West out there.
yeah, it is the Wild West, and we're in it. How much time do we have, by the way? Are we going to one?
We're going to one. We got about 15 minutes left.
Okay. So I'm going to go fast on this. This slide is about what's available in the market. So traditionally, you might have 150% extended or 200% extended replacement cost in a standard carrier, and now carriers are coming in with 110% extended replacement cost because in a declaration of emergency, they have to pay out extended plus replacement cost. So the where I want you to look is the total after deductible. On the 110% extended, you have a total policy yield of 1,090,000. If we were to sell you a $1 million policy with 150% extended replacement cost with a wildfire deductible of 50,000, this is the case. While the Department of Insurance will not allow a wildfire deductible on admitted, you have a total extended of 1.5 million and your deductible is 50,000. So instead of 1,090,000, you get 1.4 million.
Yeah.
So I don't know why they don't believe that this is good for the consumer. It does shut out some people who have smoke claims, but we could lower insurance rates if we get rid of $1 billion of smoke claims per carrier. That means that they're going to come in with lower rates for everybody. And really, if you have a $30,000 smoke claim on $1 million house and you can't afford it, now we're starting to get into like financial psychology. Like, does it make sense to even own a home? Like the American dream says, own a home. But do you really need to own a home? Like, because if you can't sustain those types of losses, like for this on the smaller end,
Yeah.
then in a lot of cases, you don't want to be in a position where you've got $1 million home that's going to rebuild for, say 1.8 and you're only getting 1,090,000. No one is going to put that kind of basis back into their house to rebuild it because you won't ever get it out. So,
Right.
and
No,
then
that
this, go
that's
ahead.
fair, Brian. And I think that really goes to the point of kind of what is the purpose of insurance? And again, kind of to our philosophy, really protecting against that catastrophic loss. And I think that actually dovetails nicely into another question that was asked just about small claims.
Hmm.
And it was specific to sewer and water backup, but I think kind of
Yeah.
the heart of the question was really, um, are insurance carriers dropping customers for small claims, and
Yes.
or should you be making small claims on your policies?
If you have small claims, more than one, you're going to get dropped. And if you have a small claim than a large claim, all claims are the same to a carrier. There's a saying in the industry: experience leads to severity. If you have more than if you have two claims inside of 5 years, there's a really good chance you're going to get canned. Period. If they're small, the carrier's just glad they got you out of their system before you had a large one. Filing small claims is a really bad idea. And if you're calling State Farm or Farmers or Allstate, know this: you can't ask them if you should file the claim. They have to, by law, file it as a claim. So if you think you've got something small, call Alex, let him know what's going on. He can connect you. I'm happy to tell you whether you should file a claim or not on your insurance. You know, and the first person you call isn't the insurance company, it's a contractor. Assess what is going on. How much is this claim likely to be? Where is this water coming from, and what is it? Because
Great
if
suggestion.
it's 5 grand, you do not want to put that flag up for an insurance carrier. Now, a water claim, there's a 5 year moratorium on any house. If you're buying a house and I look up that that house has a water claim inside of 5 years, most of our carriers will not write that home if it has a water claim inside of 5 years.
Yeah,
You can make a house unsaleable. Um, the
that's
one thing
helpful.
I
Thank
want
you.
to talk about on this slide, we're seeing a declination of coverage offered. Um, so the total yield on a private client traditional, policy like a Chubb is like 4.4 million. Traditional middle market like State Farm, you might get on a $2 million house, 3.2 million. That's why Chubb's more expensive because they pay more. But what we're seeing in the new middle market is we're seeing very low extended, 10%. We're seeing other ones in the lower end admitted carriers. Agents are actually calculating the replacement cost on homes below market. So they have these replacement cost estimators. I'm routinely seeing houses that are $2 and $3 million replacement cost houses at valued by agents at $1 million, because a lot of the carriers coming in aren't filed to write above $1 million because of their financial ratings. So be really careful about using an admitted carrier that might undervalue the home, because that's a really big deal.
Yeah, that's an issue that we see with some frequency, and
Yeah.
something we definitely try to bring to light.
So we're coming in on 10 minutes. I'm going to skip a couple things here because I want to talk about the nuts and bolts of what we look at. This is going to help you more than some other data. So this is part of a spreadsheet that we use for doing an analysis for insurance. And the first thing we look at, this was a client that we did. This slide's a few years old, so the numbers are a little lower than they would be today, but you can understand the ratios. Um, First of all, who has title to the home? If your home is titled to a trust, you need to add that trust as an additional insured. Several carriers declined claims in the Palisades fire because homes were titled to trust, and the carrier came back and said, you don't have an insurable interest in the home any longer because Mr. and Mrs. Smith don't own the home, it's their trust. So you want to make sure your trust is added as an additional insured. Premiums, obvious, we track that. What kind of home form you have. If you were renting out a house and you moved back into it and you didn't change your insurance, for instance, you have a dwelling versus a homeowner or vice versa. If you don't have the right policy form, the carrier doesn't owe you any money. That is established federal case law. You're
Yep.
never going to get paid if you have the wrong insurance. Um, this policy had $1,000 deductible. When we talk about small claims, having $1,000 deductible is a bad idea because it forces you to maybe think, well, I could file a claim. I have a $5,000 claim. I'll get $4,000. We bumped this up to $10,000. You can see what it did to the premium, right? They were paying $2,000, $2,000 a year, 2,100, call it. And, we bumped that to 2,800, but we also bumped the deductible to $10,000. In today's market, this might be a 5,000, 15,000, or 20,000 in some cases on a home that's 1.5 million. But you don't want to have, you want to assess where your deductible should be by break point. You go into the carrier and like, if I have a 10,000, how much do I save? If it's a dollar, you know, you don't go up. But if it's, $500, you might want to save it. And because you can't file small claims anyway, you might as well save any money that you can.
Agreed.
The home was built in 1998, so we know that there's some building ordinance or law issues, right? There's a lot of code in California between now and then. The home is 3,800 square feet. So that tells me that there's some nice stuff in it, right? When you start getting into above 3,000 square feet, you start getting a lot more granite and hardwoods and things like that. And so this house was insured for $176 a foot. And here's where the settlement things begin, right? Because he was insured for $677,000. We calculated the value of the house at that time at 1.5. So he was underinsured by more money than he was insured for.
Yep.
Which means that on the settlement options, that was a rebuild, replacement cost, or actual cash value if you don't rebuild. So the carrier would be trying to go in and devalue that $677,000 if he had a loss.
Yep.
And now he's getting actual cash value well underinsured. We replaced it with a policy that had insured to value at $400 a foot. And then we put in a policy that had a cash out option. He's an older gentleman and he's like, I'm not rebuilding this house. I want cash. So we used a cash settlement policy with 200% extended replacement cost. But notice he had 150% extended replacement cost on the extended replacement cost line. Even with 150% extended replacement cost, it didn't bring the house to its actual value of replacement cost at 1.5. And this is what, and both of these carriers have sort of exited the market now because the first carrier, they don't want to pay out $1,016,000 in a loss. They're not priced for that. And Chubb doesn't want to pay out $3 million on a $1.5 million home if they know that someone's not going to rebuild it. So both of these carriers are affected by the laws that occurred. And then on the second slide of this is where we start talking like building ordinance or law. So I like Excel because I can take all the moving parts and put them in a place where we can see them all.
Yep.
It's hard to see the moving parts in a 40 or 50 page document that's written for an attorney to read. But he had, 10% building ordinance or law. So on a 1998 house, we're going to have to replace every single window with higher energy windows. That $67,000 is what the windows are going to cost on a 3,800 square foot house. So we're going to use that up on windows before we even get to seismic or electrical or anything like that. So he won't have enough building ordinance or law. And then other structures, turns out he had a pool house, so we had to build something in there because that pool house wasn't insured. It wasn't insured to value. And sewer and water backup on this policy was excluded. And so we brought in a policy that had sewer and water backup. So all of these things become visible when you start building yourself a spreadsheet on how it works. But if you're just reading the policy as a layperson, it's very difficult to do. So back to the question on how to hire an agent. What is the process that they're going to take you to? Ask them to give you an analysis. If they're suggesting insurance, ask them about these moving part coverages are the most important. This is why I'm calling them out. Building ordinance or loss, sewer backup. I have $500,000 of liability, but is there personal injury included in that? So you can, by asking a few of these questions and using some of the language here that I'm giving you, as a consumer, you can protect yourself a lot and eliminate somebody who's just like, well, I don't know. What's building ordinance or law? I talked to a State Farm guy. We moved a bunch of business from a carrier that was leaving the state. AIG was leaving. And so we moved a lot of business over to State Farm because it was the right thing to do. They were the last admitted carrier that was doing it. We're not State Farm agents, but State Farm was the best carrier for them. And I talked to an agent and I said, you need to add personal injury to this. And the State Farm agent didn't even know what it was.
Yep.
but he sells these policies all day long. I said, well, here's the deal. You should go back through your book and put personal injury on every single one of your clients, because sooner or later you're going to have a claim and someone's going to have a kid with a cell phone that gets the family in a lawsuit. And how are you going to feel when you have to tell your client that you could have had coverage for $15, but you didn't know what it was, you know? So
So,
anyway, we
so
have to use a different State Farm agent now because he doesn't like me. He thinks I'm mean.
Brian, this was so helpful. I really think this Excel sheet that you've created at the end is a wonderful tool that potentially the audience members could use if they were looking to analyze their own policies, or to your point, if you're working with an agent, ask them to put something together like this for you, and you
Oh
could
yeah,
really use this at least as an initial checklist. For our clients, we do put together very similar analysis that looks
yeah,
at current coverages. So for our clients, we are doing this already. But if people have insurance questions, you're certainly welcome to reach out to us. We are not the insurance experts, but we certainly have been around the block a few times. And we know how to redirect questions either to your current insurer in a way that may resonate more with them, or we certainly have resources like Brian, where we can ask questions to him. You're obviously welcome to reach out to him as well. Brian is a wealth of information and is more than happy to share what he knows, and will not try to sell you a policy, especially if he doesn't think it's appropriate. But I do really want to say, Brian, thank you so much for your time today. This was a fantastic presentation. We received a lot of feedback just saying how wonderful this was and how informative it was. So I
I'm
really do
glad.
appreciate
Thank
your
you.
time today. For those that had questions that we were not able to get to, we will follow up by email. But again, if anybody has any follow-ups, you're welcome to direct those to me and or to anyone else on the Integris team. And if you would like Brian's contact information, please feel free to reach out. But again, thank you so much for your time today. Wonderful webinar, and Brian, thank you again.